Welcome to the first episode of the Make It Click podcast. These are conversations that I've been having with founders and investors. Today on the podcast, we have one of the original Toronto podcasters in tech, Matt Cohen. He's the founder and managing partner of Ripple Ventures. They're an early stage VC based out of Toronto. They have offices in Toronto, Vancouver. They do deals internationally in Canada. He's been a very, very instrumental force in the Toronto ecosystem. In today's episode, we get into a lot. We get into, what are the early signals he looks for in startups, how they look at, teams with just the inkling of an idea. Some of the companies he's investing in aren't even incorporated at the time of investing, where the companies are based, what he sees different between, maybe Toronto founders, Toronto investors versus those in the Bay Area. And kind of what makes companies click at a very, very early stage. So very awesome and very kind of him to come on with us today. We're looking forward to launching into things, and thanks for tuning in. Let's get into it. First of all, thanks so much for taking the time. Good to see you. Really appreciate it. Appreciate, I would say you're probably the most seasoned podcast guest I've had.
Okay.
But I would say also on that, this is kind of substitutes a coffee meeting. Okay. So I'm not doing any coffee meetings this year.
Okay.
None of that.
I love that.
So instead, people I want to have coffee with.
Right.
I'd love to have a lunch or coffee with you, time and blah, blah, blah. I do this and just pack it all in. Maybe we can just kind of start just a little bit on you.
Sure.
Kind of what you're up to these days.
Sure.
And,
I think I've done the
Ripple.
You've
done it a few times.
Oh,
probably
sure.
a few times today.
A few times today, exactly. Never stop selling. So I'm Matt Cohen, founder and managing partner of Ripple Ventures, based here in Toronto with offices in Vancouver, BC as well. I started the venture fund in 2018, and really, I couldn't even spell venture capital, honestly, when I started it. You and I met probably right after I just launched the firm. Right. I really spent about a decade of my first part of my professional career in finance and capital markets. We're here, just off of Bay Street. Yep. I worked on Bay Street and Wall Street for almost a decade for the Royal Bank of Canada, and then for a bit at National Bank. And that really shaped me in terms of my investing mind. Yeah. But it was all public market facing. So I never knew anything about the private markets. It was all public markets, trading on behalf of the bank's balance sheet, as well as global hedge funds, some of the largest, hedge funds in the world, some of the smartest investors in the world that are still investing today were people that you would have to pitch ideas and conversations and trade for. Mm-hmm. And that's where I spent about a bunch of my time in New York and in Toronto working, during the global financial crisis was pretty intense. And then I came back to Toronto, and the ecosystem here.
And you're an Ontario guy.
I'm a Toronto born guy. I went to school on the East Coast in Dalhousie and did a BCom finance, major there, and had some co-op placements that got me onto the trading desk at RBC. Sidebar, they thought I was an MBA grad, but I wasn't. I was actually just an undergrad with a BCom. And so I did that.
That's out there now.
Yeah,
it's the non-editable.
The HR department would love to hear that, I'm sure now, but no, it's fine. I was actually the first trader that was licensed to trade. I tell my team this all the time. There was paper tickets. First approved co-op student to license to trade in my third co-op term. Wow. Yeah. And I was fully licensed. I had all the regulatory exams done and stuff. So it was pretty cool. Yeah. I would say that was a very formative time in my life. Still some PTSD from it, but a lot of lessons learned during the time working, in finance. But when I saw what was happening in New York, I know your company was kind of started a little bit later than that, but in 2009, 10, and 11, there was Silicon Alley. Yeah. And that was the Silicon Valley of the East Coast in New York. And there were companies kind of bubbling up. Yeah. Business Insider was always writing these headlines that I always saw. And I was like, what is this? But I didn't grow up in the States, and I never really knew anyone in New York from that community. So when I got back to Toronto, I wanted to find that community. Yeah. And it was still very nascent.
Totally.
And so fast forward, I connected with a mutual friend that introduced me to eventually the founder of the first company I ever helped start as the founding investor, called Turnstile. Yeah. It was a Wi-Fi marketing analytics business. I wrote a check to start that from scratch with no idea, barely. And eventually that company was acquired by Yelp in about 4.5 years. a great outcome personally, and learned a lot. It was like a fast track MBA
Yeah,
to
totally.
startup life.
Yeah.
And then that got me down into the early stage investing world as an angel investor, and fast forward to eventually launching the fund in 2018, 2019.
And how much of time kind of went by in your post exit life, angel investing, and then Ripple, or was it like,
2017 to 2019, essentially. So I
okay.
had basically had like no money
Yeah, yeah,
to do any of this angel investing kind of
Mhm.
stuff until I had the first liquidity
Yeah.
event with Turnstile. And then I basically rolled half of the proceeds into a bunch of early stage investments,
As an
everything
angel.
as an angel. But what I realized when I was living in Boston at the time, I was hanging around a lot of the MIT, Harvard student populations. The investing groups down there
Yeah.
were amazing. Family offices there are also
Yep.
quite, active. And I would say, my name's Matt. I'm an angel investor. And they'd be like, with who?
Yeah, yeah,
And
yeah.
I'm like, oh, right. There's nothing to show that I'm actually an
Yeah.
angel investor. So
Yeah.
I actually went to Vistaprint.
Yeah, yeah.
I created a business card.
Yeah.
I created a LinkedIn profile. I
Yeah.
created a domain address with an email
Yeah.
address. I called it Ripple Ventures.
Oh, cool.
It
Okay.
was the concept of the ripple effect was
Yeah,
in
yeah.
my mind the whole
Cool.
time. Like
Yeah,
the small decision led to bigger outcomes
yeah.
later on. So I just set it up.
Yeah.
And I actually did it because it was much easier to break into introductions to founders,
Totally,
especially in the
yeah,
US,
yeah.
when I had that name
Oh,
associated
totally.
with it. But it was just my money.
If it was a Gmail, it'd be like,
Right.
nowadays, though, I feel like if the Gmail one comes in, it's like, oh,
Oh,
this guy could be real.
It's true. Yeah. Like eladgill@gmail.com. It's like, oh, this is legit, right? Yeah. So that's absolutely true. It's gone the other way.
Yeah, exactly.
So I did that though at a time when people were still like, getting started in their angel journeys. And that really opened my eyes to a lot more opportunities.
Yeah.
Luckily enough, some of them turned out very well. Some went public. Some had I was early in some blockchain stuff. And those worked out really well.
Yeah.
And that first pool of capital had a very high return on it. That it caught the attention of some family offices and investors here in Toronto and some in New York.
Pre-fund.
Pre-fund.
That angel. Okay.
Pre-fund. So and so then I sat with these families. They asked to meet with me and they said, hey, we'd like to invest with you.
Mm-hmm.
I was like, well, I don't know what that means.
Mm-hmm.
I don't really have the with me kind of structure. What do you recommend? They're like, well, there's a lawyer on Bay Street who I knew.
Yeah.
Go sit down with them and they'll tell you how to set up a venture fund.
Yeah.
And I had to learn the ABCs of venture that way.
Yeah.
LP, GP, managed
Yeah.
all these things. And that's how the first fund got started. Now, I did end up putting a lot of my own capital into the first fund.
Got it.
I had a partner that was a large limited partner in the fund as well that helped get it off the ground. And in fact, where you probably actually met is we had an office before COVID.
Mm-hmm.
That was an incubator called
Yeah.
The Tank.
Yep.
And that was the,
Yep.
Inclination of,
Totally.
Tank Talks.
I remember.
That's how that started.
You were very helpful. I would say I've never been a T4 in my life. I've only done my own startups.
Right.
So when you only do your own startups, you have a lot of these kind of like shadow periods, right? Where like
Career breaks.
Yeah, career breaks. Exactly. A pivot, a career break, an angel check without a business yet or something. So you were super helpful. I remember that office very well. And I actually had to follow up with somebody on your team because I actually forgot to give back the key.
Yes.
So no, that was very nice of you. And that was on Adelaide.
You're right.
Yeah,
You
yeah.
squatted with us for a little bit. I
Yeah.
remember a couple
Yeah,
of months.
Yeah. It was real. It was real for sure. Very helpful. Definitely remember that. And then what about so the fund's going, the kind of the focus. So like you have Ripple Ventures is now a structured fund. You did the angel thing.
Yep.
That was definitely a conduit, a reputation builder, a proof point of, hey, this is not, he's been doing startup investing.
Yep.
Now he's going to formalize it. Was there like a Canada only focus? And that's where it gets a little kind of like, because there's more and more funds, more and more companies in Canada.
Mm-hmm.
But it's always tricky to see like, okay, which one's Canada focused? Which one has like, they only do investments in Canada? Was there any geo focus? Was there only B2B?
Yeah. So, it's interesting when you get started with your first fund, you're always about sort of like promising and then delivering, right? It's an empty promise at the end of the day. You're asking for people to commit to a pool of capital that is yet to be invested, and you're hoping that you can deliver on that promise. with my situation, I actually took the two largest angel investments I had made and rolled them into the fund at cost. So there was already two companies in the fund.
Got it. Okay.
Funny enough, that first company we rolled in, we ended up selling as our first exit, which was called On Call Health. So it worked out well for our LPs.
Yep.
But there was a focus on early stage, but it really also was a factor of my network.
Yeah.
My network was New York, Boston,
Yeah.
Toronto, and a little bit of SF.
Yeah.
Because when we sold to Yelp, everyone moved to SF. So that was my network. A majority of the fund ended up being local just because of that network. And that was
the investors in the fund.
The investors were local. The companies we backed were local. And that was, again, just a factor of like the network we had. And then in hindsight, that selection bias is not great. Now, COVID obviously accelerated the ability to do remote deals, but in 2019, it was a factor of your network.
Yeah.
And so that's how our focus kind of evolved. But it was a very early stage focused, high ownership, high concentration, and very hands-on focused investing around the B2B software kind of landscape, as most early stage Canadian funds always get started.
Yeah.
Unless you come from like a deep tech, space tech background or a research background, it's hard to go to that lane.
And there's nobody really, I think maybe people view this later and like, what the heck? I'm that guy. But there's no one really doing a lot of consumer deals in Canada.
No, not necessarily. Yeah, you're right. There are some. There are some funds that are run by Canadians. They're just not in Canada. So you're saying like a DTC or a CPG kind of focus fund? Yeah. Not really. And I think that's just because of the LP base here. It's just not used to it. You got to remember, all the capital in this country is real estate and resources.
Exactly.
Right. Yeah, so when you have that as your sort of like benchmark of like, I could also put my money here.
Yeah.
You can't go out on a limb and say, we're going to do consumer when there haven't been mass. But when there's a big Shopify that you can lean on as like an example.
You can point to it.
Yeah. Or like, you've got like the Clios and the Slacks and the, Cloudflares that all have Canadian connections. People say, oh, maybe we can also do that.
Totally.
But on the consumer side, it's very hard to point at all those right away.
Totally. Yeah, totally. Yeah, it's tricky. I would say on the B2B side, do you find it, so there was, so that's where you played.
Yeah.
Early stage B2B, high ownership. Was it the deal flow? Probably naturally was a lot of Canada deal flow.
Of course. And we, there was Techstars around in Toronto. So we had some companies that kind of went through that program. We had founders that I had backed personally that had networks that they also attracted us to as well, which helped.
And today, if I went on your site, which I did, last week, kind of just still primary. It's the primary focus seems B2B. Is it as much Canada focused?
60-40, I would say, is the split. Now, I'll be honest, like nowadays, a Canadian company is hard to describe, right? Because you've got Canadian incorporated companies, but operating in the U.S.
Yeah.
You have U.S. incorporated companies operating in Canada, or you have companies building in Canada, but they're incorporated in the U.S. and they're all funded by the U.S.
Yeah.
It's very hard to really understand what a Canadian company is. But to say that we are a majority Canadian focused investments, and we're coast to coast. And we are not just B2B anymore. We've obviously opened up our aperture as everyone has had to with the world that we live in today with AI and deep tech and space tech, defense and everything. So we have definitely broadened our scope. The only things I would say we don't really focus on is like pure life science. Like we're not into the therapeutics or drug formulation side. We're not into pure like hardware, even though we did announce the Canada Rocket Company deal. So that is definitely hardware. And we're definitely not on consumer still. We don't do any consumer. And, we are limited in certain ways of what we can do regarding like maybe some crypto and stuff like that.
Got it. From LPs?
From LPs, yeah.
Got it. So you wouldn't do like a dating app or like a...
Personally, maybe.
Yeah, totally. Yeah.
But not out of the fund.
Yeah. Got it. Okay, cool. And then what about the founders that you work with?
Mm-hmm.
You said hands-on. What is that like? Look, so I guess the title of this podcast, Make It Click. So I would say when an investor tells me hands-on, I think about it in various ways, right? I'm like, okay, what does that mean? And I would say like some investors are like very customer, like they're very good with customers. They go down their whole portfolio and like truly make the intros. And when it comes down to it, a year goes by and you're wondering how your business is doing. It really just comes down to like customers, you signing up customers.
Of course.
So that kind of hands-on is great. But what does that mean? Like make it click for me. Is that like you're taking board seats? They're at your office. What does that look like?
Yeah, so it's evolved as well. You know, in our first and second fund, we were leading rounds primarily in the Canadian companies. So we were the first investor.
And these are priced
These
rounds?
are safe notes or sometimes priced, but now they've leaned more to like the safe structure just because it's easier. Round sizes have also gotten bigger. But just to keep it in the Canadian U.S. context, Canadian companies were typically leading or co-leading checks, and we're often taking a board observer seat if there already is a board. And if there isn't a board, we ask to be on the board when the board is eventually structured.
Okay,
but we don't really have a preference. It doesn't matter.
Yeah.
The focus really, though, is because we're so early, we're inception style investors. There's no incorporation sometimes. There's no bank accounts. There's basically no team. It's just the core founding team.
Yeah.
So customers at that point is almost not even relevant.
Yeah.
Right now, it's about focusing on product, recruiting, and raising capital.
Funding,
Right?
Yeah, got it.
That's where we get really, really hands-on. So we are very active on the fundraising side. We have a very strong co-investor network.
Yeah.
And our fund history has shown that our graduation rate is way above early stage funds.
From like
Pre-seed to seed to Series A.
Okay.
The numbers are from pre-seed to seed is around 80%. From seed to Series A is around 60%.
Yeah.
And then Series A and beyond is still yet proven out, but we have over 50% of those. So there is a very high bar that we try to meet when our companies are graduating. And that's because of our downstream investor networks. Our ability to obviously put a lot of the material together. So a lot of our founders, you know, when they're raising capital,
never put a deck together.
Never put a together, put a
Their
data room
website's not
together.
up.
They have nothing. So that's definitely a big.
They don't want to pay for DocSend.
Right. So we have a roster of venture partners who work with us and are compensated through our funds. They also help on a lot of customer introductions, due diligence, stuff like that. Recruiting. There's 4 pillars that we care about. First one is team. Is the team technical enough to build this product, or do they have to pay and hire somebody to help them build it? The second,
Go. You
team.
Go.
Okay. Then the second one is problem.
Okay.
Is the problem validated by us, not just you as a founder? A lot of people come and say, we found a problem in some supply chain. Great. Thank you for telling us about this problem, but let's go and find it ourselves. So team, problem is validated. Then the next one is recruiting. Can you recruit talent? And do you have a network to even recruit from? Or are you kind of fresh out of school and you're kind of just going around your university clubs and trying to find
job
people?
boards.
And then the last one is raising capital. Okay. Raising capital in this day and age is not for everyone. We have some companies, they call them safe strapping or seed strapping. May never raise again. And that's great. But for the majority of like power law, venture style outcomes, you do need to raise capital. And that's a big thing. So do you have the ability and the muscle to raise? So team, problem, recruiting, raising.
And on the kind of inception, is it, you know, I meet people in my network, whatever, people that have worked at our company, very talented folks. They want to kind of do a startup. And I would say like that right there is like sometimes the hardest thing. Like they'll put time, like they won't work. Don't have a day job. They'll like kind of think about concepts and like they want to do a startup, but they don't have an idea. Is that like a little too early for you?
That's not even really a thing. I mean, I've had people come to me and say, I've had this idea, but I don't want to quit my job until I get funded. And I say to them, have you thought about what an actual startup journey is like? Because if that is something you're not willing to take a risk on, then you're definitely not ready to take a startup life. And that's hard. So an idea or I want to be a startup founder is not enough for us. I truly try to tell people, you have to speak to other founders who've gone through the grind.
Oh my gosh.
Especially the ones who've failed to get their sense. Of course, you're going to have the dropout, you know, high school or college founders who on their first go, they had a big hit. That's like 1 in a billion. What you want to know is like, what is it?
And you might not want to fund them.
Exactly. What you want to know is like, have you found a problem you're actually passionate about? Because the why, like, why are you doing this is more important to me than just because you want to do a startup is not important.
Totally. So there is a bit of kind of like a bit of a framework, a bit of a problem. They have a bit of a passion for that segment, but they might not have customers.
No, none of our companies have customers at the time we work with them usually. So that's not a problem for us. Because a lot of the times the problem that they're trying to solve the customers that they're going after have never even heard about this problem being framed this way.
Yeah, so it's a new
It's
like,
very
category
novel, a new category
Yeah,
sometimes, or it's a new novel solution that has never been thought about being built that way.
Yeah.
We do go out and find customers a lot. Some of our LPs are some of the largest conglomerates in Canada.
Yeah.
They have a huge, customer base that we can tap into. So we definitely go after that. Our sweet spot is helping companies get their first pilots off the ground.
Yeah.
And we act as a conduit to those customers, whether it's through our, private equity firm relationships, whether it's our corporate service providers, corporate development teams, and then overall just large businesses that we've incorporated with over many, many years.
Yeah, totally. With the vibe coding you mentioned on the team, people kind of can build a prototype overnight with kind of talking to some prompts in Replit or something like that. Is the technical founder, like if a technical founder walks in the door, are you looking for a technical founder, business founder? Like if I'm you and I'm sitting there and it's a business founder, it's like, but you're going to have to like, oh gosh, it's like, you're going to have to build something. How is that going to, like me, maybe.
That's me too.
So is it like ideally one of the founders are technical?
Ideally, but it's not a blocker. I mean, like you think
I'm
about,
sure you've done successful deals.
Well,
where
like one
it's
of the most
business
successful business, non-technical founder, a little technical would be like Parker Conrad.
Yeah,
right?
sure.
From like Rippling, Zenefits, right? He found a co-founder during his YC batch. But like, I would say, we definitely want to have somebody who has the ability to build an MVP in-house to be a technical founder. But
they can fundraise against it. They can get a few customers, get to the next step of the journey.
The 10X founder is the one who's technical and can speak the language of business. That's great. Yeah. What we definitely find is a lot of the younger student founders that we're backing are very technical and they have zero clue about the business, partnerships, customer conversations, fundraising side. Totally. That's why I mentioned the 4 things. When you can knock off like 3 of the 4 and we can supplement one, that's fine. Yeah. But if you're like 50% of those 4, that's not enough for us. And the bar today, because of how cheap and easy and fast technology is being built, it actually hurts you by being just a business founder or just a technical founder.
Yeah.
The other thing I would say is like we've done founding teams of like 4.
Yeah.
That's also a little too much sometimes. Yeah. It becomes very difficult as the company graduates to have 4 founders.
Yeah.
So I'd say like the sweet spot is like usually 2 or 3.
And why on that one? I know a company, Canadian company, you would know the name. You're not an investor. They have like 5 founders.
Right.
I'm a customer of them. 5 founders. Is it the economics or is it just life? Like both. 5 founders are not going to work. It's just like life gets in the way. They're not going to work together for like 5 years.
You don't have 5 partners in life.
Yeah, exactly.
Right? Like, some do, but I've never seen it work in most life. So I agree. Like it's economics and it's life choices, right? So what I always say when we meet with young founders, especially when there's like 4 of them, have you had the conversation?
Yeah.
And they're like, what conversation? I'm like, well, why are you doing this? What's your number where you tap out?
Yeah.
Okay. And who is actually going to be the one person leading this all the way through?
Yeah.
And that is something a lot of people are uncomfortable with, especially at a young age when you haven't really been through the motions of like breakups and stuff like that. Yeah,
exactly.
So we have those conversations for them.
Yeah.
And then every year after they've launched, when there's 4 of them or 3 of them, we ask them to have the conversation again.
Yeah.
Have the conversation again. Yeah. Have it again. Yeah. Make sure you're all on the same page. And if the breakups start to happen, it's okay because we've had the conversations and those founders, they knew that their time was up. Like they knew they couldn't give 110%. Yeah. So they're like, I'm going to put my hand up and I'm going to tap out. Yeah. And if we buy them out or do a secondary or find a new investor to buy them out, there's no hard feelings. Yeah. And we've had those conversations.
Yeah, that one's tricky. Like 5, even 3. It's like 3 I could see working. But the like large founding teams, just from economics as a side thing. Yeah. Just like life changes. Like one could meet their partner and have to move to Brazil. And it's like, it's just a totally different dynamic.
I mean, that's why I started are all hard.
Yeah, exactly. Right. Like are all 5 going to work in the office 5 days a week?
No.
Exactly.
3 is usually where we kind of tap out. So 2 and 3 is, like I said, our sweet spot. On the 2, it's because one's business, one's technical, and that's usually the easiest way to divide it. On the 3rd one, in today's building environment, you have one that's on like the engineering infrastructure kind of build out side, and one's on like the AI, the research side of it, and then the other one's all operations, business, fundraising.
Yep. Because of how early you guys get involved.
Yeah.
I would assume it's like the riskiest capital. It could be. So I assume there's probably some pivots.
Yeah, lots.
How do you see those play
I
out?
love them.
Yeah.
Love
Yeah.
pivots.
Me too. I'll tell you my story later, but
Yeah,
that's
I
for a
love
different day.
You've pivoted. I don't know. I love pivot. I hate the word pivot. Actually, I don't think it's a really fair.
Yeah, yeah.
I think it's it's a learning, right? From what you obviously got wrong.
I
in your
call it
hypothesis.
an evolution.
There you go. Perfect. That's what I was thinking of. An evolution. I'll give you the perfect one. We had a company that was in like the database management side, trying to help companies manage their databases more efficiently, save costs, blah, blah, blah. And they pivoted to consumer healthcare.
Yeah.
I couldn't have been a more 180.
Totally. Yeah.
And it was awesome to hear them come to this conclusion on their own
Yeah.
without us pushing them. But they needed us to push them to go forward on the
Sure.
evolution.
Yeah, yeah.
So everyone has these pivots. What we asked them to do is like, just give us three.
Yeah.
Like 3 real ones that you've gone down the pivot path with,
Yeah.
and choose the one you think makes the most sense, but explain to us how you got to that decision. I don't want you to just come to me with a pivot for the sake of pivoting.
Yeah.
So I want to know the steps you took to get there and the lessons you obviously learned from the prior ones, but absolutely. I love that. Now there's other things that I would not describe as full pivots where it's, you're just changing your ICP. The product is the same.
Totally, yeah.
The go-to-market's changing. The ICP is changing.
Yeah.
Those aren't pivots.
Yeah.
So that was the biggest pivot I've ever seen.
Yeah.
And I loved it.
Yeah. Is there a time where, there's 1 or 2 pivots and it's kind of maybe doesn't take off
Yeah,
and
you
it's
shut it
time
down.
to shut it down? What's that like if you're managing a fund? Because thankfully I haven't had to do that.
Sure.
But like
The
what's
best
that like?
investors are hitting 80% losses.
Totally.
Best.
Yeah.
So
bet.
it's part of the strategy. What I will say though,
You're in the Hall of Fame.
yeah, if
Venture
you're-
investing.
Exactly.
If you're missing 80%.
Yeah, exactly.
Interesting.
I would say though, for us as investors, we actually care a lot about our losers or our shutdowns or whatever you want to call them, more from a reputational standpoint and also for the founder's second and third act,
Yeah.
that we actually dedicate a lot of time that
Yeah.
other investors would not care about. And we've
Totally.
seen that.
Yeah.
We've seen other investors who are very hands-on, very helpful, essentially turn their back on these
Yeah.
founders when it's time to shutting it down
Yeah.
because it doesn't move the needle for their fund.
Totally.
And we're the ones left holding the bag on
Yeah.
helping shut it down, helping get the paperwork done, return the capital or whatever it
Yeah,
is.
Yeah.
And those founders remember that forever.
Yeah. Yeah.
And me and my partner, Dom, we always say like, why are we doing this?
Yeah.
Like it doesn't move the needle for us financially. I said, because that is the ripple effect.
Yeah.
These decisions now will pay us back, and they already have, because remember, these founders introduced us to their friends who have other startups that
Yeah.
could be very successful, or this founder comes back around for their second act 4 or 5 years later.
Yeah. And you're totally open to that.
Absolutely.
Yeah.
We love it. Now, I will say that there's some founders that come back with a newer version of what they failed on,
Sure.
and I don't like that.
Yeah.
It's like clean slate it.
Yeah.
I know you're still in love with this technology you built, but it's like kind of start fresh.
Yeah.
If you want to do that, like do it on your own,
Totally.
right?
Yeah,
You
yeah,
don't
yeah.
need venture funds to do that
Sure,
same product
sure.
again that we invested in.
Yeah. 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 Makes sense. And also kind of in the pivots, you mentioned you do a lot of safes.
Sure.
Primarily probably all safes.
Yeah.
Like the fund life cycle, I had a few VCs on this podcast.
Sure.
Funds you would know, people you would know these folks, you probably speak to them weekly. And one of them talked about is like the fund life cycle.
Mhm.
Like that's like, whoa, these things take time.
Yes, they do.
And it's like you invest and it's like 10 years goes by, company hasn't really done a Series A. It's a thing. So what's your take on then liquidity? Like, how does that work? I
Yeah.
mean, the founder still ons the majority, or the founding team still owns the majority of the company.
Mhm.
Cap table's pretty plain vanilla, handful of investors on safes 10
Sure.
years ago, maybe a bridge round here or there, safes. How does that,
Totally tough thing for LPs.
is that
I'm an
Walking Dead?
No, not necessarily. Look, I mean, the best funds, again, the J curve is what you're kind of talking about, where it goes negative for the first 3 to 5 years because you're taking out the management fees and you're investing seeds in the ground, but you're not seeing any sort of value or fair market value go above 1x, right? And so that is a real thing.
Yeah.
If you can get out of the J curve fast with, kind of early breakouts, that obviously helps.
Yeah.
Keep investors motivated. But I'd say it's a real thing. And so the way that we supplement that is 2 things. One is, we are early investors at very kind of lower prices than hopefully the next round do. And we have sold. So we've sold on Series B rounds. We've taken secondaries out while still holding a majority of our position and returning like really good, capital distributions back to our LPs. And that's why our fund one is a top decile fund. But I would also say the other thing we do work very hard at is manufacturing exits for companies that are not going to hit escape velocity. So what that means is we speak with a lot of private equity buyers, a lot of corporate development buyers, and we have a lot of M&A advisors that we work with who will help find homes for companies that won't make it to Series A, Series B, and beyond. And what we'll do is we'll take stock in another kind of Series A, Series B company and let us ride
and you're
that.
in the game.
And that works. And that works really, really well. We actually almost sold a company. We decided not to move forward and raise the Series A instead to a company that got acquired, I think it was like 8 months later for like $400 million. And we would have rolled in at like, maybe like 50 million. So there's ways to make money that way that we also work out. And that's great because those companies that you would say as losers, maybe they were only going to return 1 to 3x, can now be a 10x fund. So that fund one, we sold our company to private equity backed owners. We got cash and stock. The stock has performed very well. And we actually received a distribution as well from that company too. So there's multiple ways to return capital.
And that wouldn't maybe have necessarily happened if you didn't have that platform, make that intro.
Absolutely. I think we manufactured, 13 exits.
Got it.
Manufactured in the sense that like the company founder says, I don't have it in me to go Series B and beyond. Or we say, you don't have it in you, plus you don't have the metrics to get to that next phase. We need to run a process or get people to start talking to you now. And usually we're the ones leading that.
And what if they're like super happy with where it's at? Like, what if they're like doing, I don't know, then 25 ARR,
25 million of ARR, and they're just not getting the growth though?
Or they don't want to do a Series A or maybe,
so
one or the other. It's just not happening.
So what we do in that
because there's a lot of those companies.
Absolutely. So what we do in those situations, say, hey, look, we're 7+ years into this investment. We have a 10-year fund life, but we really have like 3 1-year extensions, so 13 years. Some funds are going to 15 years now. What we can say to the founders is like, look, we believe in you. We think you're building a great business, but it's just not doing enough for our fund.
Totally.
We will bring a secondary buyer in. And if we're on the board, then we can obviously have that conversation. Or if we're not, we can say, look, we found a buyer who wants to buy this and they're willing to do a small primary and a larger secondary. So it doesn't affect you from a dilution. You get a new active, motivated partner to drive new enterprise value. And we're willing to take chips off the table. And the founder is actually usually helpful in accepting that. They want that because they know how much we did to get them there in the first place. Totally. And that's worked for us.
Do you have to kind of manage at the very top of the funnel at the start of the relationship with LPs to get this kind of sorted so they know that, hey, if we're in a deal and it's year 8, that there is you can't guarantee me anything, Matt. Can't guarantee me anything, but we know your DNA.
So
and we can have some comfort knowing that this thing is, a 25 million ARR zombie. There's something there for us.
It's not a dead end. I get it. So what we do is a couple of things. One is there's individual secondaries on one companies that you can do to get LP capital back. You can do continuation vehicles where like the best companies of a fund, when it's at year 10 or something, roll into a new fund that has a new life to it. There's like barely any fees on it. It's just like its own little SPV almost with multiple companies inside. And some LPs can roll if they want to roll, and others can get bought out at the current book value. And then the other part is a full LP secondary. And we've done this before where you have a group of LPs that have been in since the beginning. The fund is doing well, but they want to get some of their money out. They want to take it chips off the table. They will sell to another LP that will buy their stake at a discount to the current NAV because of obviously the liquidity. And then those LPs move on and they're out of the fund. And that happens as well. And we've done those transactions before.
Got it.
So there's multiple ways to kind of slice it up for LPs.
Do you, as you kind of have built the fund, invested in a lot of deals, see way more deals than you invest in, is there kind of a trend in Canada specific to the country we're in, that things that you certainly see, it's like, wow, I'm glad we see this. And then stuff maybe that you just don't see that you see in companies in the Bay Area.
So are you talking about characteristics of founders or just the style of companies now?
Yeah, maybe the companies, the founding teams. Yeah, just the DNA of, I guess, the DNA of the company at the early stage.
I've never been more energized or excited than I am today investing in Canadian companies. One, our platform and our firm like brand and reputation has just gotten much broader, so more people know about us. So maybe that's why we're seeing some really great founders. We see about 10,000 companies a year.
Wow.
But when we say 10,000, that's 10,000 people.
Yeah.
Because we're not investing in companies sometimes. They're just people that we're tracking.
Totally.
But what we're seeing a couple things happening is one, there's this huge like Build Canada initiative, right? You keep reinvesting back in Canada. It's happening from the pensions to the institutions to the government and obviously locally. So that's really great. The quality of founders we're seeing though are also exceptional. So you're getting a lot of like hardcore technical engineering focused founders now getting funded to start companies. Yeah. You've got the AI wave, obviously, of technical research, founders spinning out of different institutions like Vector and Mila and all around the country. We're seeing that. You got DeepMind, Cohere, those kind of companies are all around, spinning off talent. Yep. Now that they've hit unicorn status with secondaries and those founders have a little bit of liquidity. Yep. We had the Shopify, spin out founders that we've backed as well. We're just seeing more of them, which is really great. Yeah. I would also say that I was just down in LA the other week for the Upfront Summit. That entire conference, which has been going on for 14 years, is incredible. Brings together the best investors, founders, and operators. It was Los Angeles. It's run by Mark Suster from Upfront Ventures. It's one of the best conferences out there. This one was all AI and all space tech, deep tech. That was the whole conference. Yeah. And so that's just the gravitational pull of the industry these days. So yeah, I feel like if you are pitching a traditional B2B SaaS, it's tough. Yeah. As to investors right now, I think there's so much capital going into like the top biggest, AI companies and deep tech, Anduril, space tech, SpaceXs of the world. Yeah. It's hard to get mind share from venture investors these days. Yeah. So what we are trying to do is like divide our portfolio, right? We've got the real venture scale kind of businesses that we're backing. Yeah. We've got some of the traditional B2B SaaS early stage AI kind of companies. Yeah. And then we have sort of the middle ground where they can kind of go in different directions, but the technical team behind them are so exceptional that we are often the only Canadian fund investing in these companies because there's so many US investors trying to get into these founders companies.
Yeah. Interesting. Now, is that obviously you can't, when you're raising a fund, it's, I would assume, very similar to if I'm raising money for my company.
How so?
Is it you're out there, you have a deck, you're pitching, you're raising money. But the thing is, you can't necessarily time it with the trend. So for instance, if you're a startup and there's an AI thing happening, or if you're a startup and you're going through a pivot and there's like a, defense tech thing happening and you're kind of sitting there with, a seed round that you've gone through half of it and you're pivoting, you're wondering what to do next. Okay, well, everybody's writing checks for defense. Maybe I'm opportunistic. Sure. You can't really do that with a fund and just like pivot the focus and say, oh, by the way, we only want to see defense tech pitch decks this week. How do you kind of manage, I guess, deal flow and doing deals that are trendy? Because there's a lot of VCs that I've talked to that are like, hey, right now I'm doing no AI. Right. I'm staying true to the core. There's so much good B2B stuff happening. Yeah. And those are going to be around in 10 years.
I would say you have to do it from a portfolio construction model. You have to be in those types of companies that have the trends, that have the market pull, but also understand what your core benefits are to founders. Like if you've never done deep tech or anything in like space tech before, and you're saying we're going to be a space tech fund, founders are going to call bullshit on you, and you're only going to see the worst of those because the best investors who've been in that space forever,
of course, they're going to want to see it.
It's the example of like, why are you seeing an oil and gas deal from Texas when you're living in Toronto? Totally. Right? Yeah, it's missed every single Texas investors. Yeah. So I believe in that. But when you do see things in spaces that are quite unique and new, but you have had relationships with the founders for a while, that's different. So the Canada Rocket Company, we've known the CEO for many, many years. Sure. I helped advise him on his last company. Yeah. So we had been tracking, we've been talking even before he started with the new idea. So yes, it is a space tech company building rockets, but the founder we've been working with for years. So that's very unique. So I would say you need to there's got to be exceptions to the rule. You got to break the rules sometimes, but LPs don't like it when you say, I'm a B2B SaaS investor now going fully all the way to the other side. Yeah. You can have a mixture of it, and that's what we've said. So our investors have been with us for many, many years. our institutional investors who've come on recently in the most recent funds have also understood how we're evolving and the industry is evolving. And the last thing is you have to educate your investors like they know nothing about what they are reading in the media.
Yeah.
And that's what we do very transparently. So
Got
we
it.
do speak a lot about why we're shifting. So in our quarterly updates, we send a lot of information on like the market, the trends that we're seeing and where we're focusing our attention so that it doesn't come as a surprise.
Totally.
I'm an LP in a bunch of funds and I am always surprised that I still don't even get like an investment memo or like a deal summary on why they just did a deal, or I barely even know they did a deal. I just see in a quarterly update they just did a deal. It's crazy.
Yeah. And your founders obviously send regular updates.
I wish. So listen, because we are the first investor often, we do have a process. We onboard all of our founders into our firm. So they get onboarded into our group Slack channel where all of our founders and companies live. They get a template for monthly updates. We hope they start to do it. We have biweekly check-ins for a certain cadence up to like 6 months. There's a lot of structure we have around reporting. But what we've done is we've actually kind of shifted our reporting to fit their needs, but still fit our needs. And AI has been at the center of that.
Totally. Yeah.
So we have
dashboarding and
actually we have a structure where if we do phone calls, the transcripts from those phone calls where updates are spoken about go into our reporting dashboard. We have physical monthly updates that we take from them. And then we have our Slack channel where we get updates as well. All of that gets consolidated and our AI agents are putting that into our reporting dashboard so that when we write our reports to our LPs every quarter, it's already all in there.
Got it.
So we don't make it really hard for the founders if they just like to do Slack or phone or email updates. We'll meet them where they are.
And it's probably not super hard for you to report out.
So easy now.
What about the founders? It's kind of the easiest topic, like sitting here on a podcast, super easy. What's the difference? Canadian founder, U.S. founder. It's like a very easy topic to talk about, or at least bring up. So I'm not super creative in bringing that topic up. But is there certain kind of characteristics where you kind of have met enough founders building in the Bay Area, then you meet a few founders building on Bay Street, and there's like, oh, guys, like this one's not like the other. Do you see that?
Always. I always said this when I lived in New York and I would come back to Toronto for work or visits or whatever. In New York, you could see a person wearing a polo golf shirt and, khakis and think they were just like an everyday person. But yet that person manages like $100 billion hedge fund.
Totally. They're taking the subway.
Very unassuming. In New York, you see someone walking on Bay Street, they've got gold buttons and a pinstripe suit. And you're like, oh, this person must be super successful. Person barely just got a bank teller job. No offense to bank tellers, but you know what I'm saying? They're just entering the workforce. And there's this persona difference that I find. But the ambition of American founders often, not saying all Canadians have lacking ambition, their ambition is like nothing I've ever seen. I was at the conference and overheard some founder talking to his other co-investors being like, I could raise 10 million, but fuck it, let's go for 100 million. And he's like, yeah, let's do it. And he's like, I don't need 100 million, but I really want to build this and I don't want anyone to really bother me for a couple years. So I don't want to just raise piecemeal funding. I'm going to go for the 100 million. And I was like, wow, good for you. And so that kind of mentality is something that we're obviously working towards here. I often find too that because of the investor population, the LPs or individual angels, there's a lot of focus on downside protection and downside scenario planning instead of optimizing and focusing on the best case. And that to me, as a investor, an operator, a founder, I find that to be almost the most draining sometimes around conversations with founders. I'm not saying to ignore it and not
like founders plan for that.
Investors try to push that onto founders. Do you notice what I mean?
Yeah, for sure. Yeah. And I think that's because a lot of their LPs, the way they've gotten wealth, is more traditional
real estate resources,
real estate, which are
I always can sell the property at some price, and I can always sell the
or I can rent it, or totally. And so you're saying from an ambitious trait, you might find in the U.S. some founders are shooting for the stars a little more. Canada maybe, but the investor appetite much less ambitious, more downside protection in Canada. Is what you're saying?
I would say that has definitely been the trend of the past. It's definitely changing now. Everything geopolitically has forced us to look at ourselves in the mirror much more honestly.
Yeah.
And I think there is now the next generation of investors coming up are much more ambitious, trying to do those kinds of things that I've ever seen before, which is super exciting.
Yeah.
And I also find that the investor group of my kind of vintage now trying to build their firms are all speaking the same language, where it used to be like one firm was trying to really break out on its own and the other ones were like, look at that person, they're doing something crazy. Now I find there's like a bit more of like, let's all row together into going for some really big bets and ambitious things, while also understanding the respect and relationship we have to maintain with our investors.
Of course,
and I'm an investor in all my funds, so I understand what it feels like.
You are, or Ripple?
I am an investor in all my funds. The general partner, myself, is always a large investor in our funds. And that's an important relationship that I will always maintain.
For sure. Of course.
So I have to put my LP hat on and my GP hat on. But I think that the conversations now are like, I remember when we made our first investment in a company called VoiceFlow. It was, crazy. It was called Story Flow at the time. They were doing children's stories on Alexa devices. I remember some LPs were kind of mad. They were like, what are you doing investing in an Alexa children's storytelling application? I was like, listen, this is not the business we're investing in. It's the team and where the technology trend is going in voice and eventually AI, and eventually came around. But I could only imagine how, some investors here would have felt if we wrote the first check in some AI thing that was like very early on, just like you would know. Like those conversations happen a lot, and you almost have to go against the grain, especially in venture, to hold on long enough to be right, while fighting that kind of anchor being pulled down from the energy of investors.
And you mentioned you are personally an investor in all of your funds.
Of course,
for sure. My question: you're an investor in some venture funds. You are, not Ripple. What are some funds that you're like, whoa, I want to kind of take some of those traits? They're like, you kind of see them, right? I really like how they do that thing. I wish I could do it here, or I want to do it here.
I talk to investors from all funds every single day. It's like my obsession. My wife always says I don't watch TV or anything. I just watch YouTube interviews. I listen to podcasts. Obviously I have my own podcast, and I just keep studying sort of the best of the best. And that's the coolest thing about building a VC fund nowadays is like all this information.
It's out there.
It used to be hidden in vaults. Now you can just get it anytime you want at your fingertips. So I love learning from that. But I would say the things that I love to ask other GPs about how they built their firm is exactly that question. Not your best investment lessons, but your best firm building lessons. How did you manage your younger associates and then principals and mature your partners? What kind of structure do you put around sort of managing your LPs and managing your founders and all these like infrastructure things about like a startup would care about? I ask those questions all the time. And I'm constantly talking with our largest investors, asking them for their thoughts and their feedback on things that we are thinking. And that to me that's just going to make me a better investor. See, a lot of people, when you take on institutional capital, people think, oh, it's just a large check. It's actually not large check. You're getting all of the benefits of what they've learned from all the other GPs that they've invested in over the years. You get to go to their AGM where all their GPs are as well. And you get to basically have natural relationships with those GPs because of the mutual connection from that institutional investor that you get to learn from. And that to me is the best thing you could have is having that older, more mature and more experienced, founder GP group to basically ask the questions to that you're eventually going to walk down the path through as well.
You mentioned a bit earlier that, hey, sometimes founders might, I don't know, you didn't say this, I'm saying this, run out of steam or they might not have what it takes, or they haven't thought about that deeply. What kind of from your own entrepreneurial experience, what for folks watching this, for them to get a little bit of a crash course in the next 5 minutes of talk time, what's kind of like the stuff they got to think through before they like actually go do it? Maybe not on the business, how to fundraise on the team, but just the life setup.
Totally. We talk about this a lot. You've had to go through it as well. There's the financial conversation, just like, is this a risk you're willing to take? Number one. That is something we talk about. In fact, we have founders who are really young. They've never really built anything before. And they say, I want $1 million for fundraising, and I'm willing to sell you 10% of my company. $10 million valuation. And I say to the founder sometimes when I don't know if they're really committed to this, they're just on the early inklings of, can I get this funded to go do something? I'll say, well, you want 1 million for 10% of your company. What if I offered you 10 million right now?
Yeah.
Would you sell me the whole thing? And they pause.
Yeah.
Like, wait a second, you're going to give me 10 million for this idea?
Yeah.
Well, if you think it's such a brilliant idea, so
Yeah.
big,
Yeah.
are you willing to sell for 10 million? Or are you going to go over the distance and try to go for like 100 million or a billion?
Yeah.
You try to get that out of them. And they should have that conversation with themselves because look, I'll be honest, I've had people ask to buy my fund, my venture fund, and people do that, right? And I thought about it. I really thought, I was like, wait a second.
So
like,
they just come in and take the positions you have.
They basically buy like the entire management company, the funds, the brand, and all that together.
You wouldn't sell them the pod.
I wouldn't sell them. That would I'd spin out. But I thought about it, and then I was like, wait a second. I've already gone through like the worst part of kind of getting this thing off the ground. Now it's time to really see if I can go to the next level, right? And so, but I think founders have to have that honest conversation with themselves. And so we have those conversations sometimes for them. We push them in that conversation. And then the other thing I would say is like, okay, what's your life situation, right? Like, are you married or do you want to have kids and all that stuff? It becomes harder.
That's a
Trust
tricky
me,
thing.
it becomes very hard. How much time do you want to dedicate? Do you have like a work-life balance mindset? Because that's really hard too.
What does your partner do?
What does your partner want to do? And all these things. And like, have you failed at anything before? You know, what did you learn from that? And was that hard? Because it's about to get 10 times harder sometimes. And so you just want to be really brutally honest.
And why is it going to get 10 times harder? Like, what are the things that happen?
Because everything you think will go right almost goes wrong. I always say like, when founders tell us in their updates all the good stuff, I actually get very upset. I want to know what the hell went wrong, what you missed out on, what is not working the way you thought it to be. Because if you're covering those up, they're all just going to snowball, and we're going to hear about it at a board meeting in a couple months or in a couple quarters, and it's going to be the worst. And we can't fix it because it's too late.
Too late.
So the biggest question is, don't believe your own bullshit. And that is like number one rule as a founder: don't believe your own bullshit. And we have founders, like one founder I'll never forget. He was burning hot, and he was like, "I'm gonna go raise."
full of bravado.
Bravado, but also like financially, he was burning the capital. To grow into a fundraise. And I was like, "Listen, we don't have as much time as you think to fundraise." He's like, "I got the numbers, I've got this. It's gonna be blah blah blah." And I was like, "You don't have it, and I'm not gonna be here to be the one to like tell you I told you so, but I'm telling you so right now."
Totally, and that's the time to talk about it.
And sure enough, it didn't work out the way it did, and we had to do a bridge round, and that was fine. But like, he came back around. Maybe a couple months later, after picking himself off the ground, he's like, "You were right." He's like, "I don't want to tell you this, but I'm going to tell you. You were right. I was wrong." I was like, "I don't want to hear that. I just want to know what you learned from this process." Because this is what startup founders often go through, but they never talk about. And we as investors and operators and founders want to be the one to have those tough conversations. And you know, you hear about people sleeping on the factory floor, like, well, you don't want to, you sleep on the floor in your own house. Sure. I that's great. But that's not what I'm talking about. I'm talking about making payroll. I'm talking about trying to get your stuff organized.
A lawsuit.
You know, some of those things. And the founders who say my best investors are the ones who are there through the worst times, not the ones who are there just through the best times.
Self-preservation. Like when things go bad, everybody, preserve, right? Everybody, the fangs come out and people try and preserve their own thing. Oh my goodness. And it's really in business relationships. It's like, who actually is going to pick up the phone, give you the time of day, work through it. And like, unfortunately, my thing in startups, or my experience, is a lot of time the bad times, it's like you need money. So it's like not everybody. You can talk. Can talk, and we can. But it's really at the end of the day, you can't really write a check. Thanks for making me feel better. Thanks for motivating me.
That's a hard one.
That's the hard one.
We've gone through that now, like with a company that's like we're not writing a check. But we're there supporting and trying to be, but we're also trying to fight for our own sort of survival in the way as well. And at the end of the day, if I was like, you're not writing a check, this person is, and therefore they're dictating what's going to happen. And I was like, you're right. At the end of the day, that is the honest zeros and ones. But life is not just about this transaction, is what I always say. Remember this. The people you see on the way up are the same people you see on the way down. So remember that.
Wow, you're full of these.
So I've had to use them a couple times, unfortunately.
I'm going to get some t-shirts.
But exactly. But the thing I would say too for founders is like, the don't believe your own bullshit is fine. But like, it's not always about the good things or the bad things. Those too shall pass. Celebrate the wins, but celebrate the losses just as much, from a way of explaining what got wrong. So that when it comes around again, because they always pass around, you're much more prepared. And that's what second and third time founders like you are much better at.
Thank you. I feel like don't know that much, but one thing I always also try and say to founders, just for me to take the pen for a second, is like, I hate losing more than I love winning.
That's perfect.
So it's like these wins, it's like
Progress.
a lot of progress. A lot of it's going to be like luck. Like
For
you
sure.
stayed in the game, you kind of got lucky.
Right.
I think the skill is like when like good things start looking alike and are happening every day.
Yeah.
It's like, okay, now like we did 10 demos yesterday. Now we're doing 15. Now we're doing 12. Okay,
trend
you
line.
obviously have done something there. That's a skill.
Sure.
Good for you. But when like somebody books a demo and it's like American Express, you stayed in the game, but there's a bit of luck there. Whereas when you lose, there's a lot of you probably didn't do something or did something
Right.
for that to happen.
Yeah, you obsess about it.
Yeah. So you should be obsessive. You should get your, never waste a good crisis.
Totally.
But no, I like these. I wasn't kidding about the t-shirt thing. You would never start a new startup? You wouldn't do a startup?
I have ADHD.
Because like you see all these ideas, some of them bad timing, some of them maybe later on, tuck it
I
away
have
for
a lot
later.
of people coming to me to ask to start something with them.
Sure.
And I always say, I'm not the person you want to be at the front of the pack.
Yeah.
I'm much better as a wing person to push you along and get you back online when things fall off. Because I also just like, I see so many different things. Like I love kind of doing a lot of different things at once. We are doing more kind of studio style.
I was going to say, because you had the fellowship.
Right. So the fellowship and what we had Dwell and Swell, which was like a builder community,
Is
is
that
now
different
evolving.
is that the studio?
It evolved into this.
Nice.
So it goes Ripple X, which was like a student population, 3,000 amazing students.
And that's the fellowship.
That's the fellowship. It's now evolved into a Dwell and Swell program, which was really for builders and hackers to come together and do projects together while they were still doing their jobs. And now it's evolving into a studio. Because technology is cheap to build. We have a ton of ideas but problems we've also seen.
Yeah.
And now we have the capital and the partners to do it with.
That's cool. I think that is something that I think has to happen organically. Because you kind of have to have, it just has to have people.
The motivation too has to be
people. You
there.
have to have people there.
Yeah.
You have to have the right people.
A lot of people have said like entrepreneur in residence is what they did. It's
Yeah,
like, hey, here's $500,000. We'll pay you a salary. You got to come up with ideas and build something.
Yeah.
I don't like that.
I heard somebody really smart. I forget who it was. Maybe, but they tested that. It might have been YC that tested like, hey, I'll give you 100.
A lot of firms do that.
But the studio one, like a conscious decision on company creation, and maybe your 4 pillars are different, but like you kind of look at it like a different category, the trends.
Mm-hmm.
You have some founders that aren't really together yet. You
Exactly.
Incubate that. So, is there like a template that you're looking at?
There's a couple templates we've studied.
There's some studios out there.
There's some studios out there. Some of the ones that they have is like,
Atomic?
they'll give you, some of them are big, like Primary Ventures has one. It's like $1 million.
Yeah.
They take like 50%, or something. And then you've got the founder owns 25, and then you've got 25 for like
later stuff.
And then they kind of dilute at different stages. Some are pref, some are common.
Yeah.
I don't think that would be necessarily the way we are kind of doing it without getting too specific. Like the way we really want to do it is, we build a lot of technology. As a venture fund, we're actually building our own technology. Like before I came here, we were running a bunch of different agents on some different studio problems that we're building. And we're coming up with different solutions for problems we face ourselves sometimes, right? And so that's where we kind of are focusing. Sometimes we also hear about ideas from founders, but they haven't really built anything and they're not the right team. So then we're like, that's an interesting problem space and industry that we never thought about. Let's go deep on that for a couple of weeks and see what we find. And if we don't find anything in that industry, we may take a shot at going down that path. But these are all sort of in the very early days of like, there's no founding team yet.
Yeah.
Only once we've built an MVP of sorts and we can get people to break it, will we think about bringing in a team. That
dope.
To me is easier than trying to put out $500,000 or $1 million and say, hey, you are technical founder.
Yeah.
Go build it. We own half of it.
Yeah.
I don't want that.
Yeah. I like that. That's dope. Is there a name for it? Is this public?
I mean, it's not public because
Stealth mode.
it's kind of in stealth mode, but you'll hear about a name soon.
That's dope. I like that.
Thank
That's
you.
really cool. Congrats.
Yeah.
So it's kind of like you're just kind of all startup junkies riffing.
Yeah.
The Red Hot Chili Peppers, by the way, my favorite band.
Sure.
They've never went into the studio with a thought of the song. They
Very
just
cool.
started kind of jamming,
Very cool.
and that's how it took. So,
Wow.
I mean, Cool, man. I appreciate the time.
Absolutely.
This
Thanks
is
for
dope.
having me.
Thank you so much. Really appreciate it.
Appreciate
And I'm looking forward to keeping in touch.
Nice. Nailed it.
Awesome.
That was great.
Yeah,
Thanks, guys.
Yeah, cool. Good.
Yeah, no one's sleeping.